First of all, one of my favorite passions is baseball. Many of you may find it boring, but I love baseball. And I love the history of baseball. And in the 1940s, there was a guy named Wee Willie Keeler. Has anyone ever heard of this guy? Wee Willie Keeler? Probably not. Okay. Well, the guy hit 400. He was this great baseball player. And so one sports writer went up to him from the New York Times one day and said, So Willie, what's your secret? What's your secret? And he goes, hit them where they ain't. Hit them where they ain't. And I think that's been sort of the concept that I've followed, in my career that's spanning more than 30 years. 30 years ago, when I was getting out of business school with my MBA and kind of trying to figure out what I was going to do, I didn't follow the crowd. I went to this sort of off-center area called futures and commodities. Everybody was doing investment banking and they were doing management consulting. I saw this thing as a potential enormously powerful and growing field and was fortunate enough to sort of follow it through. And at the time, it was very downtrodden because many of you may have heard about the silver crisis. Anyway, there were commodity explosions and Paul Volcker was raising interest rates to ridiculous levels and it was a disaster in the space. And I found that as an opportunity. Nobody wants to go there. You might want to take a better look and see if you might find some value. And so today, how many years later that is, we can talk about that, so I'd rather not admit it, is perhaps another opportunity within that space, within the managed future space. Now what that is, those are portfolio managers they don't call it a form of a hedge fund, but it is sort of, if you think about it, where you just use futures to express risk. It's quantitative, it tends to be purely systematic, though sometimes managers will adjust that. And it's a strategy that has these quantitative signals on a myriad of markets, and it's called managed futures. Okay, so we know everybody talks about stocks are doing great. That's a good place to jump into the brokerage firms, and European markets are also doing well. But these are commodity trading advisors have done really badly. And what this graph shows you the returns on the top left from 1980 all the way through to 2017. If you look at from 1980, and I actually got into it at 1980, there was a lot of red in the 70s. If you look at this and you see prior to 2008, how many red? There's only 3 down years. Think about that. Think about that. In 28 years, there's 3 down years. And then since 2008, there are 8. You only have 2 up years. Okay, so the question is it broken? Is there an opportunity? Is there an old way of doing things or a new way of doing things? Do you have the skill set and the confidence to think you can go into there and maybe tweak something or get at something which brings it back on that path? That's the question. And that's some of the things I want to show you. I'm supposed to be looking at a time. Where do I see that? Oh, I got plenty of time. It's unusual. Usually by now I'm about almost out. So here you see these guys having trouble. So what's going on in the world? What's going on in the world? And I've kind of looked at some data. I love to look at data. I love to dig in and find things and try to find nuggets and then have the confidence to go risk some capital. Let's go see if it's right. You can walk the walk or you can talk the talk. What are you going to do? So I like to put it at risk. And if you look at some data here, you can see the inflation, how it was all volatile and crazy until the late 70s. And then since then, it's been coming in. But if you look at the area since 2008, inflation's dead. I mean, there's nothing going on. It is the most dead period in 70 years. Look at the gross, GDP, GNP, whatever you want to call it. It's just what U.S. sums of goods and services less inventories is. What is that sum? And you can see the volatility in how much it used to move. But it's not moving anymore, right? So you've got inflation on one end, you've got production of goods and services on the other end, and they're both like this muted, historically muted environment. The question you have to ask yourself when you look at that is it going to stay that way forever? Or will there be a change? And which way will it change? And does it matter as long as it changes? That's the question. Does it matter? So we can look at some other things that are interest rates. You guys are fortunate to be in the lowest interest rates ever in history. But the last time that happened was in the 1950s. And since then, you could see a lot of volatility. It's happened before. And then it doesn't happen. So you have these very low interest rates, with global central banks just flooding the world with cash. I'm sure you guys have read about that and looked at it and studied it and tried to understand it. It's a once-in-a-lifetime event. It's basically changed the financial system and changed the way people view risk, which is interesting, right? Is that change the way it should be? I always ask myself the question, and I'm going to ask you the question. When is it safer to fly in an airplane? Before the crash or after the crash? And it's after the crash, right? But what happens after the crash? Everybody's afraid. You don't want to get on that plane. Yesterday, some 70 people died. Well, that was yesterday. It happened. The whole world is scurrying around to fix a problem they should have fixed 2 days ago. Okay, so when's it most dangerous? So we're looking right now at this world. Is it dangerous now? Is it dangerous? I don't know. So we see even the same story everywhere. Everything's gone to very, very little volatility. So when I kind of look at this thing and I look at the opportunities in this managed future space or even in markets changing, I look at two things. I want to see changes in inflation and I want to see changes in gross domestic product. Now, any of you guys who study money and banking, do you know what that sounds like? That's the Fed. What does the Fed do? It worries about inflation. It worries about employment. What is employment highly correlated to? Businesses making money. What is that? GDP. So it's really central banks having something to do, not just flooding one system and sitting there hoping it doesn't collapse. Actually managing a growing concern or a failing concern. Doesn't matter. What's beautiful about managed futures is, if you looked at that other slide, you probably didn't see this, it says it has no correlation with other like equities. Point is, the best year ever for managed futures was 1987. What happened in 87? Oh, the stock market crashed. Second best year for managed futures was 2008. What happened in 2008? The stock market crashed. So this is something also where it's a strategy that makes money over time, but actually makes a lot of money when the world blows up. And not that it will or it won't. The question is, it doesn't have to, but it's just a pretty interesting strategy. So I look at central banks being part of this. I look at, it's reflective of a full range of economic cycles. Again, when you look at an economy, there's the beginning of the growth phase, there's the gaining momentum, then it becomes more stable, and then it goes on and gets old, and then it redoes it. But we've been on sort of the same zero interest rate, let's try to get out of our own way economy now for 9 years. And the world is now talking about, I don't know if you guys keep up with this, but finally even the ECB, the European Central Bank, is saying that it's going to start removing some of its aggressive stimulus to the world. The Fed has already begun raising rates and it's talking about how it's going to sell its massive amounts of bond purchases. All of this is like teaching a kid to ride a bike and then you take off the training wheels. You got to hold the bike for a little while, but there's going to be a few bumps along the way. And that's kind of what I see happening, is I see the training wheels are coming off the global central bank's economy. And there's going to be a little while before the bike rider is able to stabilize on his or her own. And there's going to be some falls, or they may just accelerate and just go on and ride across country. We don't know, but there will be change. And this is a kind of strategy that can do well with that change. And as you look at your careers, it's where they ain't. Nobody wants to touch this. I mean, you saw the returns. Everybody said, why would I go and do that? Well, because last year it had its biggest year ever in raising money, in assets under management. It really did, even with the difficulties. Why? Because the stock market's bigger than ever. They need diversified investment. It's real, everybody's buying indices, and so they go up. That doesn't happen forever. There's diversification. So there's a tremendous amount of potential growth in the space should it actually have some resurgence of success. Number two, it's completely liquid. Number three, it's completely transparent. And number four, every market in the world, every index in the world is reflective in a futures contract. So you can learn about anything and go off into other areas if you want. But in my opinion, this is a great time for this particular strategy. So I believe that there will be some sort of, economic, riding the bike without the training wheels economy, and it's going to go in a direction. And when it goes in that direction, I think that markets will trend, commodities like oil will move, and gas, interest rates will change, the stocks may or may not continue to go up, value of currencies could change. I even think the idea of cryptocurrencies is going to affect all of this. Just because you won't be able to track all of the currencies, which is going to create instability, which always creates opportunity. One of the things that people, you find more opportunity in chaos than you find it in stability. So that's another nugget that I believe. You know what else is interesting about this strategy? With all the talk about futures, futures, leverage, risk, all that stuff. If you had a futures portfolio forever, the max drawdown, i.e. your max amount of your loss from your high at any point in time is only 15% if you had an index of managed futures. It's only 15%. So if you had $1,000, at worst you'd be at 850. The stock market is 50. The S&P is 54%. The Nasdaq is 61%. Think about that. And it just happened a few years ago. So if you had those safe investments at your worst, out of your $100, you'd have about 41. How would that feel? Wouldn't you feel like selling about that time instead of buying? Anyway, so the whole idea is that with this, there's an opportunity. It's relatively safe. If you look at the fact that other markets have done so well because of this artificial infusion, this might be an opportunity where not just a baseball might fall for a hit, but it might go out of the park.